Hello, class. So for this session, we'll be talking about the last type of adjusting entry. Again, we're still under the adjusting accounts for financial statements, and we will be discussing accrued revenues. So you would like to get um, a reason on how to prepare and explain adjusting entries, specifically accrued revenues. As mentioned, we have several types of adjusting entries that arise from the following transactions: prepaid expenses, depreciation, unearned revenue, accrued expense, and finally, accrued revenue. So to give you a brief background, as you noticed, you have here accrued expense and accrued revenue. So in a separate video, I talked about the accrued expense and what's the nature of this one. So again, accrued expense, these are services, okay, that was delivered to you already, or services that were performed to you by your service provider, okay, or these are goods delivered to you by your seller already, okay. So these are costs that you actually incurred already, but not yet paid, and you haven't recorded it yet. So sample examples of your accrued expenses would be your accrued interest expense and your um, accrued salaries payable. So the similar type of approach will be used for accrued revenue. So typically and ideally, when we deliver services, okay, or when we provide products to our customers, we expect that we will be receiving payment for them. Okay? So it's expected that every time you render a service to your customer or you provide goods or items to your customer, you expect that you will be compensated for it via cash. Okay? However, that's not always the case. Accrued revenues refer to revenues earned in a period that are both unrecorded and not yet received in cash, or not yet paid to you via providing other forms of assets. So the bullet point number two, what's important here says that these are revenues earned in a certain period. Okay, so you already actually performed the service to your customer. However, you haven't recorded it yet. It is still unrecorded, and it was not paid yet to you via cash or 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 through another asset. To simplify it, we have not yet received cash as a payment. So if this in this case, this will be considered as an accrued revenue and is a part of your revenue, or this is a sales in your end. And this must be reported on your income statement. Again, revenues has an effect of increasing the value of your equity. To increase the value of our equity, what we need to do is to increase our asset in the form of accounts receivable and also increase the value of our equity, specifically revenues. Again, we will increase our assets, and then we will also increase our revenues by crediting the revenue account. So the common types of accrued revenue arise from fees for services and products, interest income, and rent revenue. We use service fees and interest income to show how to adjust accounts for accrued revenues. So in this table below, as you can see, every time you have an accrued revenue, the accounts that will be affected would be your asset account and your revenue account. Okay? So since you performed something to your customer, or you provided something to your customer, okay, that already constitutes as a service provided to them. Hence, you would need to recognize revenue or sales or income. And that recognition of revenue has has an effect of increasing your equity, and that increase will be shown on the credit side. Okay? And since you've already performed this to your client, you have already delivered the item to your client, right? But you haven't billed them yet, but rather they gave you what? A commitment or a promise that they will pay you sometime in the future. That promise and commitment will be an asset under the form of accounts receivable. So we will increase our asset by debiting the amount. Okay, so let's take a actual sample in the form of accrued service revenue and accrued interest income. So let's talk about accrued service revenue first. So accrued revenue or accrued service revenue is a revenue that is earned but not yet recorded because either the customer has not paid for them or the seller has not yet billed the customer. So it says here that accrued service revenue arises when either, when we say either, okay, it may arise or, okay, it may arise on the following events. First, number one, the customer has not paid for them yet, okay, whatever the amount is due, okay, and number two, seller, us, has not yet billed the customer. So in number two, it seems that we haven't billed yet the customer. We haven't requested payment for the services that we provided to them. Okay, and the first one is that the customer, it is on the POV or in the point of view of the customer, they didn't pay the amount due yet to us. Okay, so the same type here on the T accounts for your asset, you would need to increase your asset because you are expecting from your customer that they will pay you sometime in the future. That's why you have it on the debit side. And again, we already performed the service to our customer, hence we need to credit it to show that our revenue or our sales or our income increased. So we have a transaction here, okay? So this is a pretty long transaction, but prior to us performing or writing and adjusting entry, what we need to do first is to take the first step in the accounting cycle. Again, the first step in the accounting cycle is to analyze transaction. And when analyzing transactions, you need to ask yourself, is this transaction a financial transaction or a non-financial transaction? So let's see what the problem is trying to say. And let's determine whether it is a financial transaction. So it says here, on March 11, okay, our company, ABCXYZ, we agreed to provide daily lunch catering services to a customer for a fixed 2,700 per month from March 11 to April 10. Okay? So it seems that on March 11, we agreed with the customer and that we are contracted to provide daily lunch. Right? We will provide food, lunch food to our customer. And in return, they will pay us 2,700 per month. Okay? And the second sentence says that the client agrees to pay $2,700 cash to ABCXYZ on April 10 when the catering service period is complete. Okay? So on March 11 says that, okay, we will be us, okay, our company will be providing food catering services to customer A. Let's just call this customer A. And that customer A will pay us the amount of 2,700 upon completion of the 1 month contract that we have. Okay? So in this case, this is a financial transaction because there's obligation already by the client that we will be paid the amount of 2,700 on April 10. Okay? So it seems that on April, from March 11, okay, to March 31st, we've already provided food services, okay, on the amount of 1,800. Okay, so you might be wondering how were we able to get that 1,800. Okay, so what you need to do is divide the contracted amount, $2,700, all over 30 days. How did I get 30 days? So from March 11 to April 10, that constitutes 30 days or 1 month. Okay? So when you divide 2,700 by 30 days, you would be getting 2,700 divided by 30, you would be getting $90 worth of revenue per day. Okay? And since we are concerned on preparing the adjusting entry for the month of March, okay, so our date coverage would be from March 11 up until March 31. This is a total of 20 days. We simply need to multiply the revenue per day that we're expecting to receive, in this case, $90 multiplied by 20 days. And the answer here is that we already produced actual revenue amounting to 1,800 for the 20-day period that was rendered on March. Okay? So this 1,800, this was not yet paid to us by our client, because the agreement is that customer A will pay us the entire amount of the $2,700 contracted contracted bill on April 10. Okay? So in here, even though we haven't received the money yet, right? The $1,800 for the month of March, that is okay. Even though we haven't received cash yet, because what is important is that we already performed the service. And that service is that every day starting March 11, we will provide daily lunch catering services to customer A. Okay? And since from March 11 up until March 31, the date of our adjusting entry, we already deserve the revenue that we've rendered for. Sorry, we already deserve the revenue for the services that we have already performed for the last 20 days. As a result, what we need to do is to recognize this revenue on March 31st. Again, when we recognize revenue, we put it on the credit side, or we credit the revenue account, because that is the normal balance of our revenues. So as you can see here, you have here food services revenue amounting to 1,800. Again, that is just simply $90 per day multiplied by 20 days. Okay? And this revenue, we haven't received cash for it yet, because the agreement is that customer A will pay us the entire amount of 2,700 on April 10. So, what we need to do on the 1,800, this is a promise, okay, or a commitment by customer A. And that promise or commitment is an accounts receivable. And an accounts receivable, this is an asset. To make increases in your asset, you need to record it on the debit side. Again, for the same amount of $1,800. As I've mentioned previously and numerous times, for every journal entry or adjusting entry that you prepare, always update the detailed record of that account. In this case, on March 31st, our accounts receivable was affected because of the promise amounting to 1,800. So this 1,800 will be reflected in our T account or in our ledger as an increase. That's why it is on the debit side. Furthermore, this food services revenue that we've generated, this will also be recorded in our T account or in our ledger as an increase by putting it on the credit side. You can see here $1,800 on March 31st. So we prepared this adjusting entry again for the very reason that we should recognize revenue when we actually earned it. And when we mean earned it, it doesn't necessarily mean that we should get cash payment from our customer. But instead, once we provided the services to them, once we delivered the items or goods to them, that already constitutes that we already deserve the income, the sales, or the revenue as a result of our actions. Again, the recognition of this type of transaction falls under the accrual basis of accounting. The concept of accrual basis of accounting is that we record revenue when earned, even though cash has not been received yet. So in here is another type of accrued revenue in such a way that this is relatable to interest that are being generated from our asset accounts. So accrued interest income, okay, as we described earlier, these are interest can yield accrued revenue when a company is owed money or other assets by a debtor. In this case, we are the ones actually holding the note payable. Note payable provided by our customer to us. So in bullet point number 1, it just simply says that we are the recipient of the note payable. And that note payable signifies that our customer is promising us or committing us that they will pay us sometime in the future. Okay? So if a company is holding notes or accounts payable that produce interest, okay, we must adjust accounts to record any earned and yet uncollected interest income. The adjusting entry is recorded as a debit, okay, to the interest receivable, which is an asset, and credit to interest income, which is an equity. The approach to calculate interest income is the same as was discussed previously to calculate interest payable on a note. So earlier, we sampled in detail the accrued interest expense. So the same approach will be taken, okay? So when calculating for the interest income, what you need to do here is to get the value of your interest by multiplying the principal, rate, and time. And since this is a revenue, what you need to recognize or to record is an accounts receivable, which is an asset, and an interest income, which is an equity item. Right? So you may want to go back to our interest expense video to be able to know on how to calculate for the interest. Again, it is just getting for the product of your principal, rate, and time. So in this video, we briefly discussed on how to tackle accrued service revenue and how to recognize accrued interest income. If you have any questions, feel free to pin it in a comment or ask it during one of our classes. Thank you.